So Pierre, you've been a seed investor in multiple companies for years now. And the first question that comes to mind, so what's a seed investor? Why are you investing in all these companies? And after doing this multiple times, what have you learned?
Um, so the way I got into early stage investing was a function of one of my colleagues who used to work with me in the private equity fund that I was in, chose not to go to business school, which was the typical path for most of us, and decided to create an e-commerce company in London. And someone I knew growing up in Dubai um, supported him, invested into it. And to be honest, at the time, I had very low expectations. I told them, I'm here to support you. If it works out, wonderful. If it doesn't, it's okay too. But having invested professionally in companies on behalf of a fund, um, it felt like an opportunity to leverage some of those skill sets. Although I have to say, I've learned the hard way that early stage investing is very different from growth equity and later stage investing, just in terms of the risk reward profile. So that first investment was a zero. But um, my background, my education, how I grew up, etc., I was always surrounded by entrepreneurs. I love entrepreneurship. I went to Babson College, which is known for entrepreneurship. Um, so I'm a big fan of supporting entrepreneurs. Just from experience, it takes about a decade, honestly, from when these companies start until there's a material liquidity event. Um, and usually, there's a strategy in early stage investing, right, that VCs use. It's called the power law, because it's well understood that the majority of these early stage deals are going to fail. So when you have a winner, you double down, right, to make up for
Mm.
the losses of the other ones. So um, unfortunately, when you invest in these syndicates on angel lists, the amount of information you get back is really limited. Um, and it takes time until you really know if they're doing well or not doing well. You don't really have information rights. Whereas again, the benefit of investing in friends companies is I get information rights like a big investor would get, even though I invest humble amounts into their ventures.
Jean-Pierre, when you talk about seed investing, are you saying that they haven't raised money from anywhere else before you came in the picture? Or is it just, or can seed investing be coming from multiple people? Like, at what point does it stop being seed investing? Like, what's the difference here?
Yeah, so you seed is the first capital that comes into the business. And then the next stage that comes after that is when you have a priced round, typically with institutional investors. Sometimes in the middle, there may be bridges, or they may use safe notes, a simple agreement for equity, which basically postpones the valuation conversation and says, give me some money now, but tomorrow, if we make it and an institutional VC comes and puts a price on this business, I will convert your note to equity at a 20%, for example, discount. And sometimes they even offer you a a coupon rate. So that amount that you may have invested, let's say it's $100,000, and say the coupon is 5 or 6%. Next year, your investment is now $106,000, right? So it grows and it puts pressure on the entrepreneur to get to that milestone faster to convert. So so I'm coming in at an early stage before the institutional comes in, but I'm not necessarily the only person on the cap table because that's quite risky. Usually, it's a bunch of private investors who come in together either through a syndicate, like one of those vehicles on Angel List, or again, it's through the entrepreneur having relationships with certain people who know them, trust them, etc., and they all chip in into the company, and each one of these people have shares in the business.
Recently, I think a couple of weeks ago, there was this huge story about a company that was valued to almost $1 billion and had these
Oh,
gigantic
Maker.
invest. Yeah, I mean, it's you had these huge, huge. state funds, I'm not sure what you call them, but invested tens or hundreds of millions of dollars in a company. So, and that's a company that's relatively well established compared to what companies you've mentioned would be. So I'm wondering, what's the hit or miss rate at that stage? I mean,
You
since
know,
you mentioned,
that one, it's called, that company was called Maker.ai or something, right?
think it's builders or makers, yeah.
Builder, yeah, yeah. So, you know, that's a classic story of a great storyteller and FOMO, right? Where people start making shortcuts in terms of the due diligence on the company and fear of missing out and end up getting surprised, right? So, um, it's also very telling, by the way, sometimes when you look at who the investors are in the company, right? And there were some, definitely some like well-known investors in that venture, but it does happen where there is fraud involved, where the entrepreneur doesn't come clean in terms of like what they've actually built, or you know what I mean. So it happens. It happens. There were even investments that I made through those syndicates where, in a very short period of time, from when we got the investment memo, committed because there was a great momentum story, and then you find out a quarter later that the company is shutting down, right? It happened once in one of those, and it's inevitable. It's going to happen, um, and there is minimal room for due diligence, right? There's like an investment memo. You see these very professional institutions that may have come in, big names who have individual entrepreneurs who may have chipped in themselves individually. Um, and sometimes, yeah, they become zeros very quickly.
Okay, what happens when you invest in a company and they shut down? Like, what's legally what happens? Is it just money goes away, disappears?
Yeah, there's literally nothing you can do. And remember, we talked about safe notes, which are convertible debt notes, if you will, but really it's debt with no teeth. You have zero claims. It's probably the most friendly type of paper you can give an entrepreneur. So when times are good, meaning valuations are very frothy, there's lots of money going around, entrepreneurs can raise capital through safes where they don't have to put a price on the business. When it's hard to raise money, investors will request for priced rounds, and typically low priced rounds, which becomes quite dilutive for the entrepreneur. So we see the early stage investing market trends go as a function of where the market is. Right now, things are great. People can raise money with safe notes, with very high cap rates, which is basically like what is the highest valuation that you will convert this round at. Um, that's happening right now, or low cap rates, which is mostly in favor for the investor.
I think the last time I talked to the head of a VC, they were talking about deep tech. I mean, I'm in tech and I've never heard this term. Apparently, it's a VC term, which means investing in a technology that's not in the market yet. And they mentioned as well that they're investing in the future, something that will take a decade or more to actually materialize. So they invest in companies that have patents and some technology it's going to
Yeah,
take 4 or 5 years to commercialize. And so
yeah.
I'm wondering, based on the examples that you gave me, does that fit your profile, or are you more of a like, do you have to make sure that the vision of the company is clear and then there's a go-to-market strategy immediately? Or do you sometimes invest because it could be great or an idea could actually work? So how much wishful thinking versus
Oh,
how,
there's a lot of kind of wishful thinking, right? And if I had to be super honest with you and your audience, right? Early stage investing as an individual is probably not the most prudent and financially sound thing to do, because the odds are stacked against you. So it's a function a little bit of, it's fun, it's exciting. You want to be part of that entrepreneurial journey and story to support a mission, a vision that you're aligned with. But there's a reason why institutions do this. There's a reason why big organizations allocate a portion of their investable capital to early stage, but then also put a healthy amount of their portfolio towards much later stage um, investments where the risk reward dynamics are very, very different than early stage. So I think, you know, um, after being extremely lucky in life, landing at a company like Uber very early in its journey and affording me the ability to make these kind of early stage bets, um, it's not something I would advise for most people. There are platforms now that are allowing people to participate in very small fractional stakes, but if I had to give a friend candid advice, I would say, stick to more liquid markets like the equity markets. There's data, there's information that's accessible. I've done better, frankly, making individual stock bets in the stock market than I have on private so far. But I'm hopeful that some of the winners that at least on paper, mark to market, are looking like winners. I hope that when they all get realized and the zeros become zeros, when you net it all together, I hope to make at least a return comparable to the stock market. But I wouldn't go out and start recommending to people to make early stage investments.
Awesome. Jean-Pierre, thank you so much.
Thank you, Antoine. Take care.